Hello guys, welcome back to Your Boy FX. I'm here to guide and help you to understand more on how the market moves and what the smart money looks for in the market. So today I want us to talk about how a good SMC trade should look like, and we will have some examples of trades using this checklist that I'm going to show you. This can help you filter high probability setups and trade with confidence. So let's dive into it. Number one, we have market structure. So before you take any trade, ask yourself these questions. Number one, is the market clearly bullish, making higher highs or higher lows? Or bearish, making lower lows and lower highs? That is number one. You should know what the market is doing. You should basically mark the higher highs. If it is in an uptrend, you should basically mark the higher highs and the higher lows. And if it is in a bearish trend, you should you should mark the lower lows and the lower highs. So number two, we have, has structure shifted? Here we have a break of structure or change of character. Has the market structure shifted? So basically here you mark those higher highs, higher lows, lower lows, and lower highs by identifying a correct or a valid change of character or a valid B or S. So, and thirdly, you should ask yourself, is price aligned with the higher time frame direction? Is the price giving you that bias that you want after finding the how the market is moving? So in this step, you simply want to trade with the trend of the market and not against it. So basically that is what you need know in a market structure. That is the first thing. And in this, when looking at your market structure, you should mark the higher highs. Let's say maybe it's a bullish trend. You should mark the higher highs and the higher lows. And in a bearish trend, you should mark the lower lows and the lower highs, so that you could you may have that that clear view of how the market is moving. Number two, we have liquidity sweep. And in liquidity sweep, what you should ask yourself is that, did the price sweep liquidity above equal highs or below equal lows? That is number one. Number two, you should be able to ask yourself, was buy side or sell side liquidity grabbed before a reversal? And this is very powerful in most scenarios. And number three, you should be able to ask yourself, did the sweep induce traders in the wrong direction? That is number three. This is where now you have to look for those inducements. And when I say inducements, I mean inducements are there to trap traders from trying to trade from those pullbacks that we call inducements. Here is where playing smart comes in, that you should be able to locate the inducements as I have been showing you in the previous videos. So you should be having that knowledge of looking for a valid or a good inducement in each and every of your trade. So as an SMC trader, you should have that knowledge of identifying inducements. That is number two. Liquidity sweep, sorry. This is number two. Let me make it clear. This is number two. That is our number two. So number two in our checklist, we have liquidity sweep. So number three on the list, we have order blocks, or you can call them supply and demand zones. So on this, our number 3, uh, you should be able to ask yourself, is there a valid order block at the point of interest, or is there that one last up or down candle before the big move that you can see on the charts? So that is point number 1 on order block, what you should ask yourself. Number 2, we have the order block mitigation. Is the order block mitigated or unmitigated? The order block should be unmitigated in order for you to take a trade from it. Number 3 on the point of order blocks, is it located above or below the liquidity sweep that and this depends with the trend of the market. If it is in a bullish trend, you should look for an order block that has a sweep of liquidity above it, and if it is in a bearish trend, you should look for that order block that has a liquidity just below it, so that it can be your valid order block. Number 4, we have, is the order block inside a premium, or is the order block located within a premium or discount zone, depending on the direction that you are trading with? So these are the main 4 questions that you should answer yourself before before jumping into any conclusion, or before taking any trade that you want to take. So that is it for order blocks. So let's go to number 4. On our checklist, number 4, we have fair value gaps, which we call as FVG, and you can call it imbalance. So in this fair value gaps, you should able to be asking yourself, is there a clear fair value gap near your order block? Is there a clear imbalance near that order block that you are trying to trade from? That is number 1. And then number 2, you should be able to ask yourself, is the fair value gap aligned with the structure and liquidity of that specific trade that you are taking, that you want to take? Is the fair value gap aligning with that? And here is where you look at the liquidity. Let's say maybe the liquidity is the inducement. Let's say maybe you are trying to buy, and here you have to look for that liquidity, the inducement that is just above an order block, and at that point of that order block there is a fair value gap just above it. And then in that the above the order block, after the fair value gap, you should have that inducement just above it, so that the market will take that inducement as the liquidity, fill that fair value gap that is just above the order block, tap into the order block, and then go into your intended direction. That is basically what you should ask on fair value gaps before taking any decision on the trades that you are taking. Number 5 on our checklist, we have the entry confirmation. What does an entry confirmation should have, so that you can have a good entry from that order block that you are targeting, or let's say maybe in a higher time frame? What should your entry look like in the lower time frame? So what you should have in your trading plan, or ask yourself, is, on on the lower time frame, is there a change of character that is happening? Let's say maybe in the 15 minutes time frame, or the 5 minutes time frame. Only this depends with which time frame you are willing to enter the trade from. So if you are if you are a swing trader, you should have that criteria that you follow when trying to enter your trade from, let's say maybe from the 1 hour time frame, or the whichever time frame that you choose to trade from. So number two, you should be able to ask yourself, are you seeing a refined order block or a lower time frame fair value gap forming? So in this case, you find most of the time, for me, I love trading with the Fibonacci after the change of character has happened. So and most cases you find that I don't miss the trade because the stop loss will be a little big, a little bit smaller, and I won't miss that trade. So I always encourage, if you are willing to use that Fibonacci retracement tool, just enter the trade at the 50%, that shows that the trade has already come into the, let's say maybe the trade is a buy, the trade should come into a 50% zone that shows that the trade came into a discount level before you entering that trade. So these are the two things that you should look into your, you should look at or fix into your trading plan. And before I forget, your change of character, the high that breaks structure to the downside and then later the price comes back to change the character, should have a liquidity sweep before going to break a structure downside, and then market comes back to change that character. So the high must sweep liquidity before going to break structure, let's say maybe to the downside or to the upside, depending on the trend. After that, that high or low that is going to be broken structure should have that liquidity sweep before the change of character happens. That makes that trade a high probability trade. So that is it for an entry confirmation. So basically, those are the five things that you should use in making your trading plan. And I'm sure if you learn these five things, you should be able to have that the trading consistency. And each and every time before you take a trade, you should always try to at least mark each and every point on this checklist before entering that trade. That trade will be, you will be trading that trade with somehow more confidence and more guarantee that you are going to have a good win on that trade. So to add on this, for all these 5 points, you should also add risk to reward ratio. You should have a good risk to reward ratio, and your risk to reward ratio should at least be from, let's say maybe from 1 is to 3 risk to reward ratio and above. And don't be too greedy in whatever risk to reward ratio you choose to have. So another thing you should add onto that your trading system is maybe the confluences. And here we have, are there at least three confluences, for example the order block plus fair value gap plus the liquidity sweep. So the more you have more confluences in a trade, the more you will have that confidence to take that trade, and with so much confident that you will have that trade go your way. So in that, in all that, before trading, also apply good risk to the risk management. You should use that lot size that appropriate for your, that is appropriate uh, for your risk plan. So here I have a setup that I caught yesterday on GBPUSD, and I want us to look at our checklist that I have shared with you, and I want you to learn from this setup, and I want to cross-check each and every step on the checklist that I have given you, so that we can identify how you can get good setups from there. the market using this checklist. So number one, we said we should look at the market structure, and here clearly we have a very good uptrend. We are making higher highs and higher lows. So here basically we are going to look for buys. So when I opened my charts that day, I was the price was currently in this ranging market, and in this ranging market gave me a lot of information, and here is what I did. So on identifying market structure, the first thing here I can see very clearly there is a there is this pullback, and then there is this break of structure to the upside. You can see very clearly there is a break of structure, but for me this is not a clear break of structure because there is no any sweep of liquidity on this other side. But I always trade with what the market gives me. So here we have a break of structure to the upside, but I'm not going to mark it because I know this low can be taken out, and then the market continues with the initial direction. So here the market breaks structure here, came back down to break the structure to the downside. So after taking this high, market came back to break this structure to the lower side. After breaking this structure, market again came back up to trap those traders that were going to take sales from this zone because you find them identifying this as their break of structure. So they will be looking to sell from this higher time frame. So when I saw this sweep of liquidity, I knew very well that the market will come back again to sweep this low, and then after this sweep of this low, from there I will have my clear market direction. So here clearly you can see market came up to sweep this liquidity. So let me mark the liquidity sweep so that I can show you clearly what the market did. So in short, let me mark with this line so that the sweep of liquidity can be seen very clearly. You can see the sweep of the liquidity. That is the sweep of liquidity. If I zoom in very clearly, you can see there is a sweep of liquidity. This here is the sweep of the liquidity to the upside. You can see very clearly there is a sweep. So after seeing market sweeping the liquidity, so the market reacted very well after sweeping the liquidity and came back down to sweep this down sell side the buy side liquidity from this low. So let me mark the low always also. Let me mark that sweep of liquidity. It is very crucial sweep of liquidity. That is a sweep of liquidity down there. Before, let me delete this box so that I can show you the sweep of liquidity very clearly. So you can see very clearly market came back down to sweep this sweep of liquidity, and then after that we have this break of structure. Now this is our valid break of structure because this is the sweep of liquidity. So here I have my break of structure. Let me delete this. This is my break of structure to the upside. This here is my break of structure to the upside. So after seeing this liquidity sweep to the upside, I knew clearly price might come back to this low before going higher. So let me mark the order block that has a fair value gap. So I have not followed my checklist. So next we identify the liquidity. You can see very clearly the liquidity sweep is here. There was a liquidity sweep down here, and then we look for that order block that has a fair value gap. Let us mark the fair value gap. This is the fair value gap. This is the order block, I mean. So I'm not going to mark only this order block, but if you can just mark the order block in that manner. So let us just mark the order block, and then this order block, you can see very clearly we have this last order flow from this high, the last order flow from this high. This is the last order flow from this high to this low, to this low. That is the last order flow. So our order block is inside our point of interest. This is a point of interest. So our order block is inside the point of interest. And when you enter a trade from this order block that has a fair value gap, this is a fair value gap, this is a fair value gap, and this is a fair value gap. So when you enter a trade from inside this order block, your stop loss should be at least below this low, because the market can decide to be moving inside here before going to your direction. So here is the order block. You can see very clearly we have the fair value gap and we have the entry confirmation. The entry confirmation here comes an entry confirmation. Here we have the change of character to the upside, and then, oh sorry, on this other side there is a change of character to the upside, and then market came back down again to the 50%. Let me delete this so that we can see very clearly. So here you can see very clearly there is a sweep of liquidity on this high before the market came back down to break this structure, and then there is a change of character up here. So after this change of character, market came back to 50%. Let us take our Fibonacci retracement tool from the low to this high. You can see very clearly this high on this candle. You can see the pullback. Market tapped into the 50%, and you could have entered another second position from this point to the upside and target 1:3 risk to reward ratio. But for me, I entered from this zone because I had this confirmation that this is a valid break of structure, and there was a sweep of liquidity down here. So this trade was a sure win for me. So I had two entries. The first entry was from this zone, from the order block, and the stop loss was just below this zone, and the TP was 1:3 risk to reward ratio. That was my first TP. And then the second trade, I had the second trade from this pullback to the 50%, this here, and then the stop loss was just below this low because the change of character was just up here. So I had this entry from there and targeted 1:3 risk reward ratio. But unfortunately, the trade did not go to 1:3 risk reward ratio. But I managed to close the trade before the market closed yesterday. So you can see very clearly this is a very good checklist that you should use in making your plan. So thank you guys for being here. Kindly subscribe, like, comment, share, and let us meet in the next video.